Hello there. Second. How's everyone doing today? All right, getting myself situated here. All right. So I'm coming at you from Chicago. If you are here today, please feel free to put a comment in the chat. All right. Get started in a few minutes. Let a few people flow in. So I hope you are having. So first of all, happy Hump Day. It's Wednesday. We're halfway through the week. Hope you're having a great day wherever you're at. If you've seen any of my other lives, I'm a little weather obsessed. We're here in Chicago and we're on like our fourth fake spring. We don't have a real spring here, and it's actually really nice today. And so now every day here in Chicago, when we get decent weather, we're always wondering if we are in real spring or fake spring. So I'm all excited. It's sunny outside today, and we're supposed to have really nice weather for the next few days. So I'm going to go ahead and get started. Welcome to our May CFO Hour. If you are here and you could drop something in the comments and let me know you're here, that would be awesome. If you're catching this on a recording or coming back and catching it on Facebook or wherever I end up posting this, welcome. This is the second CFO office hour that I've had. We have one in April, and this is May. And the whole purpose of these office hours is really to give business owners, particularly female business owners, a place where they can come and learn a little bit about business finance, get it simplified, feel a little more empowered. I've spent 30 years working in corporate where I worked with GMs and C-level executives, and they always had a CFO, some type of financial business partner, whether it's a CFO or a controller or divisional head of their finance group, and that person was a key business partner for them in terms of meeting their strategic goals, helping them understand their numbers, helping them set their goals. It's not something that business owners really have access to. CFO, for a small business is probably going to cost about $250,000 a year, and it's generally out of range until people get up to about $20 million. And so part of what I really want to do in these calls is just bring that and make that accessible to the small business owners. So, again, my name is Carla Moats. I am a fractional CFO, a financial consultant, and a business coach and strategist. Those are kind of the three types of services that I offer. And I work primarily with female entrepreneurs and business owners. And really what I try and do is simplify their finances, help them. Often they'll come to me because they think their finances are a hot mess, and I help them get them cleaned up. And then ultimately what they're trying to do is make more money, improve their cash flow, and really they go after whatever their business goals are and build a business that fits their life. And that's really what I'm passionate about doing. So the way these calls work is I'm going to do a little bit of teaching on the call. I'm going to talk today about cash flow. If you haven't seen them, I think it was last week, I did a series of lives where I talked about ways you could improve speed up your cash collections, and we're going to kind of extend that today. We're going to talk about cash flow, because cash flow is typically when I meet with clients and I say, "What's your biggest financial challenge in your business?" If cash flow is not the first thing out of their mouth, it's usually one of the top three things. And pretty much all business owners, they need to understand cash flow. It is, you can say cash is king and profit's queen. They kind of go together. And so what I'm going to do today is I have a lot of questions that come to me either in calls I have with potential clients, calls I have with clients, things that get asked to me in Facebook groups. And so what I've really done is I've pulled out some of the most common questions, and really my main goal for you today is to have a better understanding of exactly what cash flow is. So hang on one second. I'm a little new here to the live streaming, so bear with me for a second You should be able to leave comments. I just want to make sure that's not on that, that if you cannot make comments, if you're somebody who knows me and you're on the call and you're not able to make comments, if you could like text me and let me know, that'd be awesome. But you should be able to leave comments. So one of the things I want to talk today about here, let me get my desk top organized a little bit better here, is I want to talk about what's the difference between cash flow and profit. That's one of the questions that people will ask me is, well, what is the difference between cash flow and profit? And basically the way it works is that cash flow is the money, just the net inflows and outflows going in, net inflows into your business and outflows out of your business. It's just cash. It's money in, money out. That's net cash flow. And then profit is really your revenue, your sales, less your expenses. When most people talk about profit, when most accountants or investors are talking about profit, it's really important for you to know that they're really talking about accounting profit. And accounting profit is really what we call accrual accounting. There's two methods for which you can keep your books. You can use the accrual accounting method, or you could use the cash flow method. I'm going to bank that most of you on here are probably using the cash flow method, and that's which we'll get to in my second question. That's one of the reasons I think you tend to think of cash flow and profit as the same thing. But generally speaking, if you're talking to an investor, if you're talking to a CPA, a banker, when they talk about profit, they are talking about the accrual accounting profit, where basically you take your sales revenue less your expenses. And the real difference is that under accrual accounting, what you're doing is you recognize revenue when it's earned, not when it's paid or not when it's received. And you're recognizing expenses when you've incurred them and not when you pay them. And so the example is, I went out, if you go out to a client, say you're in the service business and you do some work in January and it's worth $5,000, but you don't bill it until February and you collect the money in March. Under the cash basis, you recognize that as income in March. But under the accrual basis, you recognize it back in January when you actually perform the work. Same thing with expenses. If I purchase supplies in January, but I don't pay for those supplies until February, under the cash basis, I recognize that expense in February and not in January. And so that's really the difference. Most businesses, most small businesses are probably using cash flow unless they have inventory. They might be using accrual then. If they have lines of credit, if they have any type of investors, then they might be using accrual. Or if you're prepping yourself to sell your business, then you're probably going to need to have accrual accounting, because most purchasers, they're going to want to see an accrual accounting statement. One of the reasons a lot of small businesses don't use accrual accounting is because it's typically outside the scope of the typical bookkeeper's skill set. It requires some more accounting knowledge. Bookkeepers who are accountants might be able to do it, but a traditional bookkeeper who doesn't have much of an accounting background, and a lot of your bookkeepers don't, they're not going to have the skill set to do accrual accounting. So you typically have to bring in somebody at a higher level. I would tell you that if you don't know which one you have, I'm going to bet you on the cash basis. So that's really the difference between cash flow and profit. Cash flow is just the money going in and the money going out, and profit is your revenue less your expenses, and it typically is referring to accrual accounting. So which brings up the next question that I hear a lot of times. If I'm using the cash basis of accounting, isn't cash flow and profit the same thing? And yes, basically, if you are on the cash basis of accounting and you run an income statement, that's basically your cash flow. It's your net cash flow for the month. So in cash basis, for people who have cash basis, you'll often use cash and profit interchangeably. And honestly, most of my clients are on the cash basis, so when I'm using it, I'm often using it interchangeably, just because most of my clients, they're not seeking venture capital. They don't have a lot of outside investors. Most of them are on the cash basis. The one thing that's nice is if you are on QBO, which is QuickBooks Online, or the other competitor out there is Xero, then going back and forth between, hey, Haley, thank you for letting me know. Oh, there I see my comments. Okay, I see Haley, I see Alex, I see a couple familiar faces. Thank you guys for putting comments out there. So I know that I can actually see the comments. So if you're in QBO or Zero, which is probably what most the Zero is a competitor to QuickBooks. It's more well known in Europe and Australia, but it's similar to QuickBooks Online. It's the very standard accounting package for small business owners. You can flip back and forth between accrual and cash very simply in those systems. So if accrual accounting is something you have and need to do, maybe you're getting ready to try and sell your business, or you're applying for a line of credit and your bank has told you what we need. We need what accrual, or what they might call it is GAAP. GAAP stands for Generally Accepted Accounting Principles. It's basically the accounting standards that CPAs have to apply for publicly held companies. If they tell you they need accrual or GAAP statements, feel free to reach out to me, because that is something I can help you implement with your bookkeeper. Okay. Another question I get. This is one of my favorites, because the CFO in me like drools when I get clients that come to me like this. I'm making a profit, but I never have enough cash. And the reason I drool is because this is stuff that can be fixed. Because when you're most profitable, if you have a profitable business, and again, here I'm talking more like accounting profit, but if you're making profit, that you're more likely to not have cash flow issues. So when a client comes to me and says, I have a profit, but I still never have enough money to pay my bills, I'm all over that, because that's something that we can actually fix. And the reason that you can have a profit but not have positive cash flow, you can still be losing, having negative cash flow. It really depends on like your credit sales, because in the story, the example I gave earlier, I mean, you can provide services in January, at which point you would recognize $5,000 in revenue, but you might not pay it. You might not actually collect those money until March. If you have a particularly slow paying client, it might be May or June before you see that money. So from a profit perspective, that $5,000 is coming into your profit in January, but you're not actually getting the cash until later. So a lot of it has to do the difference between profit and cash flow. And when I have high profit but I don't have cash flow, a lot of it comes down to how I'm handling my AR, how I'm handling my my collections, and how I'm juggling my payments and my AP. So if this is you, send me an email, because this is definitely, we can hop on a call, and in an hour, I can help you figure out, at least understand why you have profit, but you have, negative cash flow. All right. My next question out there is for all my coaches that are out there. So one of the things that comes up a lot of times when I work with coaches or I work with online entrepreneurs is I have really inconsistent cash flow. I'm in feast and famine. The coaching model, typically, for those who aren't that familiar with it, is coaches will often sell a 12-week package or a 6-month package, in some cases a year package, and it's often paid all up front. Sometimes there's payment, terms. So I could get myself fully booked and say I'm a coach, and fully booked for me is 10 clients, and I sell 10 packages in that month, and let's just say each package is $3,000, and I collect $30,000 then in the month of January. But it's a 12-week package, which means I'm fully booked. So I'm probably not collecting money in February, March. I'm probably not collecting money again until probably March, maybe April. Maybe I have a wait list, so I get a deposit, and those are things we can use to flatten out your revenue bumps. But if I look at a P&L for or an income statement, when I say P&L, that's a profit and loss statement. If I look at that for a coach, what I will typically see, it'll look like an EKG. It'll have lows, and they'll have a big high, and then it'll have a low and a high and a low. And so you have a lot of this. It's very similar to a seasonal business. So what I'm going to talk about here would apply to them too. If you have a landscaping business, if you are maybe you have trying to think, maybe you run a friend of mine, I don't think she's on the call, Annie. Annie runs a summer camp. So during the summer, she makes money off of her summer camps that she's not going to make the rest of the year. So the same thing would apply here. What becomes really important here for cash flow is, what are your fixed expenses? One of the things I always tell when I'm working with coaches is go out and figure out, I call them core expenses. But what are your, core expenses or fixed expenses? These are expenses that you're incurring, that it doesn't matter if you have 0 clients or you have 30 clients. And again, I have, I have a little bit of this model, coaching model. I have Zoom. It doesn't matter if I have a client or not, I'm paying for Zoom. I'm paying for my website. It doesn't matter if I have clients or not. Figure out what all those fixed expenses are for your year. And in our case too, a lot of those expenses we don't pay every month. We pay, like I pay Zoom once a month, or I pay for Acuity scheduling once a month. And figure out what all your fixed expenses are, and that's the amount you have to cover that year, just to cover your fixed costs, and then build up a cash reserve. I think this is really important, and I think this is something particularly with coaches and online entrepreneurs that gets neglected, is that if I'm going out and I start a business that's, say, let's stick to the landscaping example, there's startup capital costs. So if I'm a landscaper, I probably have to go out and buy some mowers. I probably have to buy some, hedge clippers, or the what they call it, the weed whacker, and I have to, so those are things I had to pay up front. So I'm probably investing in my business up front. Maybe I'm getting a loan, maybe I'm buying used equipment, maybe I'm getting a family loan, a bank loan, or I'm putting my own money into it. Coaching has a pretty low barrier to entry. You don't really have to have a lot to start your coaching business. But so coaches never come in with a cash reserve. So one of the reasons a lot of coaches will have, no cash flow in the beginning is because they're totally bootstrapping the business. And in many cases, they're commingling business and personal expenses, which if you work with me, it's one of the things we want to eliminate. You want to treat your business like a business, and you want to separate your business and personal expenses. But once you figure out your fixed expenses, see how much they are, and I tell people, build up a cash reserve that will cover anywhere from 3 to 12 months. And again, 3 months probably on the low end, 12 months on the high end. I mean, if you're a coach, it can take you, from the time you start your business, maybe you're making a little bit of money in the first few months, but most coaches aren't building up a consistent clientele for a year and a half. So figure out what type of cash reserve you need to have, and establish a budget, and also a cash flow forecast. Those sound a lot more complicated than they are. I actually had a budget coming into this year. It's basically just tells me roughly how do I expect my money to come in. I made a list of all my major expenses when they would go out, and your cash flow forecast basically just takes your cash balance and it goes forward for the next ideally 13 weeks, and it says what am I expecting to come in, what's going to go out. So at a minimum, and I've actually been doing this with my business, and because at a minimum it allows me to say, okay, in the month of June, if I don't bring in some business, I'm going to have, these expenses. What is it that I need to cover? And it keeps you from, being surprised. All right. And if you need help figuring out how long that cash reserve can be, again, I offer a free profit and cash flow strategy call, and these are things we can knock out in an hour. And we can kind of take a look at it, and I can help you figure out what type of cash reserve you need to you want to have for your business, and I can help you at least get an understanding of your expenses. The other question I get, and this is actually really good. If you're asking me this question, you've had a really good year. I had a great year, and then I got my tax bill. So I sent my stuff off to my tax guy, and I got this big tax bill. The story I always tell, I like to tell in my calls sometimes with prospects is, your accountant calls you and says, oh, congratulations, you had a fabulous year this year. Your revenue is up like 50%. And he congratulates you. And then in the next breath, he says, can you write me a check for $20,000 or 25 or 30? I was actually following a coach recently who had to write a check for $30,000. But they've spent the money. They don't have it left, and they want to know how they avoid this next year. So if you haven't figured it out yet, one of the differences with being in business for yourself versus being an employee is, and as an employee, your taxes are taken out as you get paid. You get a paycheck, and they take out your taxes. As a self-employed person or an S corp or whatever, you're responsible for doing that for yourself. You don't have maybe you're an S corp and you're drawing a salary, so your salary is pay as you go, but your profits in your business aren't. You have to pay that yourself. And so the most important thing you need to be doing is you need to be allocating and setting aside your taxes as you go. You're going to hear me refer to this book a couple of times. I think I'm going to be doing a master class in the next couple of months on it. Profit First. If you haven't read the book, and this is something you struggle with, go read this book. It's by Mike, I can't even pronounce his last name, it's like Makayowicz or something. It's called Profit First. And basically what this does, I won't go into a lot of detail, but basically the premise is you're going to set up separate bank accounts for profit and for taxes and for your owner pay, and you're going to separate them from the bank account that all of your operating expenses get paid out of. But the basic thing is set up a separate bank account. So I've done this. I have a separate bank account. It's all managed through the same bank, and every month I take 15% of my revenue, and I move it into this tax account, and it just sits there. The other thing you want to do is you want to pay quarterly tax payments. You can't just wait and pay all your taxes at the end of the year without getting penalties and fines. If you underpay, you have to have paid in, and don't quote me as gospel on this, but I think it's 100% of what you owed last year or 90% of the current year, whichever is less. But basically, other than that, you can get hit with underpayment penalties. One of the ways you avoid that is you make quarterly tax payments. Now if you are making about the same as you made last year and you're paying in the same amount, most people will basically just pay in what they owed from the prior year. If your business is on an upward trajectory and you owed, I don't know, $20,000, your total liability last year is for $20,000, then that's the amount you want to pay in this year, even if your tax bill ends up being $40, because most people don't want to pay the IRS before it's absolutely due. Another thing I would say too is make sure you're doing your books during the year. I see a lot of small business owners, particularly those that are in the online business space, or they're smaller service businesses, organizers, realtors, small consulting firms. They will wait to do their books in March, or they will wait for their tax guy to tell them how much money they made. And if you know me at all, if you've seen any of my stuff, I talk about having a CFO or a finance hour every week, certainly every month, where you are doing your books every single month. You should know. Alex knows this. Haley knows this. Alex and I actually run a mastermind. We've been running a mastermind for the last few months with a handful of people where we've been teaching financial habits to them. And this is one of the things that we've really been harping on people is every month we go in and we report out our numbers. So those are the three things you can do. Check out Profit First, which is basically set aside your tax money up front. Make sure you're making your quarterly tax payments. Your tax accountant can help you with that. And which goes to make sure you have a really good, tax advisor. Next year is probably the first year I'm actually going to hire somebody. I've always done my taxes myself, but I'm finally at the point I've decided I'm gonna farm them out for this year. Make sure you're doing those books every month. All right, next question. If you have a bookkeeper, one of the things I'll hear is, every month there's three basic standard financial statements that all businesses have. There's a balance sheet, which is basically your assets and your liabilities. There's your income statement, or what's often called a profit and loss statement, which shows your revenue and your expenses, whether it's on the cash basis or the accrual basis. And then there's a statement that most small business owners really, unless they have a capital intensive business, they probably don't pay a whole lot of attention to it. And if they hire me as their CFO, that's something that I want to educate them on, because it's actually useful, but most small business owners don't use it. And it's your statement of cash flows. Basically, your statement of cash flows is one of the three standard financial statements. That's why your bookkeeper is probably providing it to you. They go into QuickBooks when they run the reports each month. It just spits out. It gives you better insight on your cash inflows and outflows. So again, if you're a cash basis taxpayer, your income statement is basically just a list of all your cash you've gotten in and out, and it represents it in a normal income statement format. Your cash flow gives it to you in different ways. It breaks it down into operating activities, investing activities, and financing activities. So when you have loans, lines of credit, if you have a lot of capital equipment, again, like if you're a landscaping business and you're investing in equipment, it's more important really to understand this. If you're in a typical service-based business where you don't have a lot of loans in it or anything, you're probably not really paying a whole lot of attention to this. If you use the accrual method of accounting, your cash flow statement is more important because it basically your income statement isn't really going to represent your cash position for all the reasons we talked about earlier. Because and again, in accrual, I'm recognizing the revenue in January, and I'm recognizing, and the cash isn't going down until March. Well, in that case, the $5,000 sale is going to be recorded in January. But if I run a cash flow statement, it's not going to be on there. It's going to be on my March cash flow statement. So again, basic thing to know, it's just a different representation. It's a better way of seeing your cash position. And if you're having cash flow issues or you have an accrual, business that's on the accrual basis, understanding your cash flow statement is more important. One of the things I'll typically do with, when I have a CFO client, ongoing CFO client, is we'll have a meeting each month to review the reports. And if they are accrual basis, we'll spend some time making sure that you understand, the cash flow statement. All right. Another question, and I did my series on this last week, is how do I get my clients to pay me on time? And this is really for people who have what we call credit sales. So credit sale is, I sold you, we agreed to something and, at one point in time, I delivered the service, but I'm not billing it to you or you're not going to pay me until later. So even in the coach, because I know we have some coaches on here, even in the coaching space, your payment plan is a credit sale. So I assigned a client this week, and they paid me up front, a coaching client. So that's not a credit sale. She said yes, I sent her an invoice, and she immediately paid it. Had she asked for a payment plan and say, split that into 3 payments, then that is a credit sale. And you need to have a way to collect that. So, but if you are a plumbing company, a construction company, landscaping companies, the online space typically is much more of a cash flow business than a lot of your other businesses out there. If you're a brick and mortar business, you're a, even in, the health and wellness space, like a chiropractor, depending, they may come in and do services and you bill them, you would have credit sales. Any place where you have accounts receivable, everything is about processes. It's great that you made the sale, but I tell clients who talk to me about how much money they sold this month, and it's awesome, it's great. You have to have sales to have a business. But once you made the sale, the real work starts, because at that point you have to have invoicing processes in place. So that's the first thing. You want to collect money from your clients, get your invoicing locked down. And in terms of how often you invoice, make sure it's accurate. It seems like a no-brainer, but a lot of businesses, I talk a little bit about how finance is like the neglected stepchild of your business. Sales and marketing, they get all the love. But finance doesn't, tends to be neglected. It's one of those things where most business owners don't really have the knowledge. And even if they hire a bookkeeper, a lot of times the bookkeeper is just doing their books. They're not really doing their processes. So make sure you have invoicing locked down, because this is where you're training your customer what to expect from you. You can look for ways to incent your customers to pay you early. I usually have clients look at this more as a way, if they already have cash flow issues, a way of improving it versus doing some of these things up front. But this is where you can offer electronic payments. Offering credit cards is a way to get the client to pay you faster, particularly if they have cash flow issues. Late fees or penalties, early payment discounts. Sometimes, what is it they say about bird in a hand? So, for clients, offering them a 2% discount to pay you in 10 days instead of paying you in 60 days can be a way to get the money in. And in many cases, it can be worth the cost of the discount. Make sure your AR processes are solid. This is another one that people typically don't have in place. This means that when clients pay you, you're applying their payments on a regular, ideally weekly basis. You don't want to really be applying them monthly. You want to make sure that if you bill them $10,000 and they only sent you $9,500, that you're putting a call into them, finding out what's the difference with the $500, resolving that up front. You're going to have what's called a dunning process. Dunning is, I honestly have no idea where the word came from, but it's basically a accounting term for sending them an automated, ideally automated now, it used to be done manually, but automated email reminders or snail mail, sending them in snail mail that says, this is a friendly reminder that your invoice, usually they're set up on a certain frequency, and they usually have increasingly stronger wording. And then you have your collection process. So your dunning process is really your automated process for letting clients, you're reminding clients that they owe you money. And your collection process is, okay, I'm going to put in a call to them, maybe it's 5 days past the due date. I'm going to put in a call to them. I'm going to make sure that, try and talk to them, find out when they're going to pay me. Maybe I have an escalation process that says, once it's 30 days or 14 days past due or 30 days past due, I'm escalating it to, maybe it's a VP of sales, maybe it's a business owner. A lot of it depends on how big your company is. Obviously, if you have, 2 or 3 employees and you are the head of sales, maybe you're the escalation point for both. But if you have 30 employees and you have like a VP of sales, he might be your first escalation path. And then at some point, maybe you're calling the client. But you want to have a collections process. That's what I tell clients is if clients aren't paying you, they probably have their own cash flow issues. And if they've got 2 vendors that they owe $20,000 to, one of them sent them a bill and has never contacted them again, and the other one is sending them daily reminders or weekly reminders, or they're picking up the phone and calling, who do you think they're going to pay when they have $20,000 available? So your collections process, so your processes are really important. This is another one when clients come to me. This is one of the first areas we'll look at because this is where, when you put some processes in place, even some basic processes, you can really affect, you can really have an impact on your cash flow. Okay, this is a little more advanced topic for, larger businesses that have, they're really ready to step it up in terms of reporting. And one of the questions I get is, what are KPIs that I should track on cash flow? One of the things I'll work with on fractional CFO clients is a lot of what we'll work on is reporting. And because the clients were often used to basically just managing on their gut. And so one of the things we're trying to do is put in some more advanced reporting. So I'm going to talk about some KPIs. If they don't make sense to you, no worries. But these are just some things, and I'll mention a couple that even small, businesses that are at the really early stage could put in place. For AR, probably the main hallmark measure is a number that's called DSO, or Days Sales Outstanding. It measures the number of days it takes you to collect payment. Unfortunately, this is complicated to calculate if it's not done automatically in your system. And I looked at QuickBooks for another client, and I couldn't find an automated way to calculate it. So if your system doesn't calculate it automatically, another alternative, which is basically just to measure your AR, what we call AR buckets. And an AR, like a typical AR bucket is, okay, this is the AR that's current. This is due in the next 30 days. This is 30 to 60, 60 to 90, and over 109 and over 90 days old. It's from the date it was due. Those are pretty standard buckets: current, 30, 60, 90, over 90. And knowing what those buckets are, looking at what percentage of my AR is in each of these buckets, and then for your business, your industry, your clients, kind of setting a benchmark. When I was in corporate, we measured the business that I was in. We focused on AR over 60 days. We had a percentage that we wanted our AR over 60 days to be less than this amount. I want to say it was like 3.5%. And it can vary, again, depending on the industry you're in. I have a client that I worked with whose clients are notorious for, it's in the construction business, and those businesses don't pay her until she's a subcontractor, and they don't pay her until the owner of the property pays them. And then even then, construction, it's pretty standard to retain 10% until the very end of the job. So, she's got some challenges that a lot of other businesses won't have. if you happen to have a clientele, so say you're in a consulting business and you work with Fortune 50 companies who are typically large contracts, but it's very typical if you go out to like the GEs or the the big companies of the world, they're like, we'll pay you at 60 days or we'll pay you 90 days. If you want to do business with us, that's just what you live with. So again, you can look at it by client, but looking at your AR buckets and knowing what to expect and setting some benchmarks for that is useful. AR turnover. This is your net credit sales divided by your average accounts receivable. It's just a measure of how efficient your collections are. AP turnover is the same way. It's a measure of the rate at which you pay off purchases. Again, these are things that an accountant, myself, whatever, can easily calculate for you. And they're basically liquidity measures. Your current ratio, this is one that if you ever go and apply for a bank loan or a line of credit, this is one of the things they'll look at. Again, this is it's your current assets divided by your current liabilities. It measures your ability to pay your current liabilities. There's also burn rate. Burn rate's measures the amount of cash your business needs in a certain period to cover its costs. It helps you figure out how long your cash will last. It actually can be useful for the people who are in these businesses we talked to earlier with really sporadic, income. And again, these are just things I'm throwing out. This is not something that unless you have unless you have somebody on your staff who's got some accounting background or you do yourself, a lot of this won't make. This is where somebody like myself. Maybe a bookkeeper, again, it depends. Bookkeepers come in all sizes and shapes. They may be able to help you with this. And in some cases, some of these numbers you can get out of your system. Depends on how sophisticated your system are. But one of the questions that I also will get is when am I ready for a fractional CFO? Because I'll tell you, not all businesses, a lot of the people that come to me, they're not ready for that. When you're ready to really dig into KPIs, that's when you're probably ready for a fractional CFO. It's typically beyond the scope of the average bookkeeper. And then the other question, and we'll end it with this, is how can I improve my cash flow? And this is where I'll do a shameless plug. If you go to www.carlametz.com/sign-up, so put a dash between sign and up, you can sign up for my free cash flow guide where I basically give you 10 different ways you can improve your cash flow. And so, feel free to go pick that up. So that's the end of my questions on cash flow. So I guess I've got some other questions that people have sent me that I'm going to go through. But I guess before I'll do that, my question would be, does anybody have any questions specific to cash flow? If you do, drop them in the comments. I'd be happy to answer them. And hello to so I see Holden Insurance Agency here. Thank you for joining us. Haley and Alex, I appreciate you guys being here. Drop them in. I'm going to go ahead maybe and move on to some of. Hey, Stephanie, I see Stephanie in here too. Like I said, I've been streaming through a StreamYard. Today I'm doing it directly through Facebook Business, so I'm still kind of getting used to all of the bells and whistles here on my little live producer dashboard. So thank you, Stephanie, for being here. Stephanie works with Prime America, and I actually did a Small Business Saturday feature with her a couple weeks ago, so which I'll actually have to go out and share on my page. All right, let's do some open Q&A. These aren't specifically cash flow. I put out a thing to my email list as well as on my Facebook page, asking people if they had any questions. And there were a few questions I got here. And so I'm just going to go through these. And so we're at the point in the call where if you have any cash flow questions, drop them in the comments and I'll come back through and answer them. I'm going to do some of this open Q&A for the questions I've already received. If you have any other questions that don't relate to cash flow, you can also drop those in the comments and I'm going to try and knock some of those out. So I got a question about money books. I love this question. In fact, I'm going to, one of my new things I'm going to be posting on social media every week is something about a book I've read and what I've taken away from it. Last week it was The Big Leap. And tomorrow's post will be a different book, and I won't tell you what. I'll make you come back and check it out. But money books specifically, Profit First. This is one of the books that, particularly for clients who hire me specifically for work on profit or fractional CFO work. If improving a profit is one of their goals, this is one of the things we go look at. We don't necessarily, I think there's different ways. I mean, I don't think you have to implement it, but if you want a quick, easy way to improve your profit, Profit First is a great book. The author and I happen to be alumni of the same university. I went to Virginia Tech, and he was there at the same time. So, but obviously we never met. My school had like 30,000 students, but again, you just got to Amazon and or Google and you'll see it. But Profit First is basically a way, and it basically flips your accounting statement. Your typical accounting statement says revenue minus expenses equals net profit, and if you watch much of my stuff on social media, you'll hear me talk about profit is the decision. Profit needs to be intentional, and that the quickest way to not make money, to not make a profit, is for profit to be passive, for it to just be what happens after you pay all your bills. The whole premise of Profit First is we're going to flip that equation, and we're going to say revenue minus net profit equals expenses. So I'm going to make my sales. I'm going to decide up front how much I want to make in profit. I'm going to set that aside, and then what I'm left is what I can spend on expenses. So the author's whole mission, I think his tagline on LinkedIn is I eradicate entrepreneurial poverty. Because it's amazing how many entrepreneurs, business owners, are basically living sale to sale, and that's really what Profit First helps you eliminate. It's designed to help you. It helps you improve and in his case, profit, cash flow are really the same thing. But he's, we're trying to get you to the point where you're no longer living sale to sale. Another book I like is Chill and Prosper. It's by Denise Duffield Thomas. She does a lot of work on money mindset, and she runs a couple of different programs. But I'm not in any of her programs. But I did buy her book Chill and Prosper. So those are the two books I go look at: Profit First and Chill and Prosper. And let's see. Another question I got was, what can you tell me about Profit First? I just talked a little bit about that. I'm probably going to do a Profit First masterclass. Profit First is very popular. Most I would say most small business owners that I talk to, sorry, my throat's a little dry, they actually know what I'm talking about when I say Profit First. So I would anticipate I'm probably going to do a masterclass in either May, probably not May, in June or July on Profit First, so you can kind of watch for that. And I'll have a chance to learn it, but it basically, again, it also makes sure you're paying yourself. That's another thing, is a lot of business owners are not paying themselves, or they're paying themselves an amount that's, between pay and distributions, it's really not enough to support their lifestyle or their life. And Profit First, one of the things you learn in that is the very first thing you're going to do is pay yourself. Money organizers. One person asked about money organizers and planners. So I'm going to talk about a couple things that I use. QBO is the system I use for my own business. Is what most of my clients do. I don't do bookkeeping. For those of you who don't know, I don't do it myself. I have somebody who I think hopefully will come back and watch the recording. I don't know if she's on the call today or not. Savannah, are you out there? If you are, drop something in the comments and give yourself a little plug. Savannah Anders, she is my bookkeeper of choice. I actually got connected to her by another coach. She's out in the, I think Oregon. I think she actually, or southern Washington. I think she's near the Oregon border. But she is a rock star bookkeeper. And most of the clients that come to me, if they need bookkeeping services, and a lot of them come to me and their books are part of why they're coming to me is because their finances are a mess. I work with Savannah, does the bookkeeping piece typically of those clients. So if you need a bookkeeper, she's your person. I don't think she's here, or she probably would have dropped a link in there. But she uses QBO. Typically, when you're working with an outside bookkeeper, they're going to have typically one system that they work in. It's either going to be QBO or it's going to be Zero. Um, there's pros and cons to each. I use QBO, so any of the clients that I'm working with, they don't have to use QBO, but if we need to do bookkeeping, that's typically what we move into. In the U.S., that's by far the most popular system. You can also, if you are do a little plug here. If you are a coach, you do not typically need QBO. You don't need Zero. This is one of the challenges I think coaches have. I said earlier that a lot of times they're waiting to find out what they've made because they go to the tax guy at the end of the year, and I think that's because they don't have a bookkeeping system. And they go to QBO, and QBO, there's a monthly fee. There is a self-employed version which is cheaper, let's say like $19 a month or something like that. But they still find it confusing, and so a lot of times the reason it's this neglected stepchild thing is because they don't understand it. So they don't do anything. They either maybe have a shoebox, they might have a spreadsheet, and they're going to their accountant at the end of the year. I have something out there that I call Simple Financials Bookkeeping Template. It's basically a Google Sheets template, but I call it a spreadsheet on steroids. It's really designed for service-based businesses that don't need and want QuickBooks. It basically is set up that you have a transaction register. It's pretty popular with drop downs. Haley's used it, Alex has used it, and it's a tool out there to make sure you have a system when you don't need QuickBooks, and it allows you every month to produce your own P&L. So you basically have some drop downs where you enter your transactions, and there's pre-populated categories that help make your tax preparation easy. It's basically aligned with tax returns, and then there's basically, I want to say 8 or 9 reports that I've pre-populated and then just populate automatically. So that's another organizer you can have. If you are I generally tell people, a service entrepreneur with less than 50 transactions in your bank account a month. The other one that you can use, I use this for personal. I don't like it for business as much, but it's called YNAB. You need a budget. It's really a budgeting tool. I will tell you that the reporting on the app is horrible. It's really bad. But if you get into the desktop version, the reporting is a lot better. But it's really the whole idea behind YNAB is for every dollar that comes in, you allocate. So you can actually use YNAB for the purpose to do profit first. You don't get typical financial statements off of it, which is why I don't like it for business. Being an accountant, I'm used to like a traditional balance sheet and income statement. But I use it for my personal, and I've been really surprised to see like how much I eat a lot, and I want to say like last month it was like $700 or some insane number. I mean, I would have guessed it was like $300, but I think I spent $700 on food and that's not groceries, guys. That's just food out. But you basically set up a budget, and every time you get money in, you basically allocate it. So it's basically zero-based budgeting, but it's allowed me to save up some money. I put money into my daughter's savings account every month, and people say that they've eliminated and paid off debt. Holton is saying so you're using YNAB for personal and business. I would love to know how you like it for business. I think part of the reason I don't like it for business is just because of how my brain's wired. Because I'm an accountant, I'm used to the traditional income statements. Do you have I'm curious, Holton, do you have like an accountant or bookkeeper who uses the YNAB data to like give you a traditional profit and loss statement or any type of financial reports? That's where I've gotten hung up on it. I'm loving it for personal. And I may next year use it to create a budget, because you can create budgets in QBO. But I could see an application for me to not use it necessarily for my books, but to use it for my, for budgeting. But there are people like Holton who are using YNAB for business. They're basically taking the data, I'm assuming, and like exporting it into a file, and they're tax preparers. It's certainly better than your shoebox. I did a training call back in November for somebody or for some business owners. They were all coaches, and I was doing like a little financial literacy training. And the very first question I asked was, what kind of bookkeeping system are you using? And I just assumed people were gonna, probably tell me a spreadsheet, because I knew a lot more on QuickBooks, and they were like pulling up file folders and shoe boxes, and I was like, no, that's not a bookkeeping system. So, so those are things: YNAB, QBO, Simple Financial. A couple of the other ones out there, I like Wave is another one. Wave is a cheaper alternative to QBO. I actually, someplace out on my social media, I did a post. I've got one on my blog too. I think about, actually, if you go out to my www.carlamodes.com, you click on the blog, there's an article out there about how to pick your bookkeeping system. But Wave, I know a few people who are using Wave. It's essentially free, which is why people like it over QBO. It doesn't have near as robust functionality, but again, it can be an alternative, for people who are trying to bootstrap their finances. How much should we invest back in our business? There is no right answer. There's not going to be an answer that's the same for every company. I always tell people that I tell people set up an intentional profit goal. I think that's really, really important. And there's probably not any single habit that can impact your ability to create profit and build generational wealth for yourself than to set an intentional profit goal. That's I just think that is. That's just like your number one thing that you need to do. But what that profit goal is going to vary. It's going to vary on your, first of all, it should be based on your personal goals. If you've already got a business, it's going to be based on where you're at now. It's going to be based on where you're at in your business. If you're a brand new person, you're just starting out, you're going to have a period of time where you're going to have some expenses, that you're going to need just to get your business up and running. And it's, what industry are you in? If I'm in, construction business, it's, 10 or 15% margin versus coaches. I tell coaches, coaches, if you're not making 70%, if you're a one-on-one or group coach and you don't have a big team, when I say big team, maybe you have a VA, maybe you have a coach. If you're not making 70% profit, we need to talk, because coaching is a very high profit business, profit margin business. So again, it's going to depend a lot on what your industry is. And again, if you book that profit strategy call, send me a DM or send me an email at carla@carlamodes.com. We could get on the call for an hour, and I could help you figure out, a reasonable number for your business. How much time? Do a time check. Got about 8 minutes left. Let's see. Holton came back, said, no, we're all commission based and our financials are pretty simple. Keeps track of commission income for different carriers and I'm able to export the file, give to my account. So that's what he's doing. Hi, Nicole. So a lot of people who are using YNAB, that's what they're doing, is they're exporting it. There is a firm out there, I think that there are a couple bookkeeping firms that will use YNAB, and I think in that case they're doing this, they're pulling it exporting it into a file, and then they're creating some kind of financial statement. So, what else do we have here? 8 minutes. Does anybody on the call have any questions? I want to make sure I get to any questions anyone on the call has. Haley, I don't know if you're still out there. Stephanie, I see you joined. Do you guys have any questions? Let me know. And let's see. The business industry, I got this question. The business industry I'm in is very low margin, like 10%. How do I improve this? Profit first. It's one thing to look at. Start small. One of the things I want to make sure clients know is if they want to improve their profit margins, let's say they come to me and they're at 10% and they want to get to 20. We're not going from 10 to 20 overnight. We're going from 10 to 11, maybe 11 to 13. And getting you to 20% could take several years. So just realize you're going to start small, because if you make too big of a change at one time, you're going to break the back of your business, because your business has gotten used to a certain cost structure and you can't just change it, flip it overnight. Another question that I want you to ask yourself is, are there other services or products you can offer that are higher margin? I have a client that I worked with And she's in the construction. They're a plumber, and they're in the construction business, and it's a traditionally they work on large fancy projects, and it's traditionally low margin. And one of the things that she's identified as an area that she can go into, where instead of the margins being 10 to 15%, the margins are 40%, and that's part of her new strategy now to improve her margins, is to basically to really focus on trying to build out this higher margin business. So this is something that people don't think about. They think about, when I want to improve my margin, going out and hustling, selling more, and cutting costs. And yes, you can do that. And that's definitely part of what we want to look at. But you can also get really creative, like this client did, and really go out and think outside the box and say, well, what is it that I can do that is, it's higher margin. And then another question. Hey, Haley, thank you. Another question. When should I raise my prices? And, what I want to say is, if you're asking the question, it probably means you need to raise your prices. First thing is, pricing is largely mindset. I know Haley knows this. Pricing is largely mindset. There's definitely some strategy pieces to it, but, if you're asking the question, why are you asking the question? Do you know how much it actually costs you to deliver your product? Particularly when you're, you're not a standard solopreneur. But even if you're a solopreneur, I mean, it's like when you think about what it costs to deliver a product, people are like, well, it doesn't cost me anything, because it's just me. But it does cost you something, because if you weren't in your business, you could go out and collect a salary for doing something. So I always tell a solopreneur, start with if it normally takes you 3 hours to deliver a service, what could you, if you didn't have your business and you were getting paid for that, what would you collect? And that's like your baseline cost of your business. So the first thing you want to do when you're when should I increase my prices, you need to really know what it costs you to deliver your service or product. Are you ready? What is the value? And this goes to another question I got, because somebody sent me a message that says, I run a consulting firm and I bill by the hour, and I hate this model. It means my sales max out because I can only work so many hours. I've been researching value-based pricing. What do you think of that? I love value-based pricing. Actually, for my CFO work, except when it's like cleanup, where I really have no way of knowing how long it's going to take, I really don't like to bill at all by the hour. I don't like to pay for it by the hour. Bookkeeping, I prefer to pay on some type of flat rate. Bookkeeping and accounting is one of the first places that value-based pricing actually took hold. And because the idea is, again, if I'm going to work, even if I'm going to work, let's say 50 hours a week, that's what I max out on in terms of my revenue. Where value-based pricing really says, what's the value of what I do? What's the value proposition to my end client? And it also allows you, I was talking to somebody recently who, if she listens to this call, she'll know who I'm talking about, who bills by the hour, but she's super efficient. So the problem was, I told her, it's like, when you get efficient, you're actually hurting your bottom line, because she bills out, say it takes her, normally it takes 10 hours to do something. So she bills out in the first month at, $100 an hour. So $1,000, and 2 months later she can do that same work for 7 hours. Now she's only billing out $700, and she's gotten more efficient, so she's actually making less money, and the value of the work is probably actually more than the hourly rate. So value-based pricing allows you basically to reward yourself, because as you get efficient, you're actually going to have higher margins. So if you're in a consulting firm, and you want to grow your bottom line, value-based pricing is definitely something to look at. So we are at 1:59. I hope people found this helpful. And we will be back again next month. I hold these calls on the second Wednesday of every month at 11 Pacific Standard Time, 1 Central Standard Time, 2 Eastern Standard Time. It will probably be via Facebook Live again next month. If you found this useful, I would love it if you would tell your friends about it. Share the posts, and send more people this way. If you are ready to up-level your business, you want help getting your finances cleaned up, and you're ready to really start figuring out how to make more money and generate more cash flow. Or if you want business coaching, I do business coaching as well, where I work with clients on both financial, type of things that we want to work on, as well as just general business coaching. I love it. DM me. You can send me an email at carla@carlamutz.com, and it's a low pressure call. We basically hop on a call, and I love talking to other entrepreneurs, about their business. I just love hearing other people's visions for their business. So, and I invite you to do that call. And thank you very much. And if you have any questions after this call that we didn't get to, I am, again, feel free to, put a comment on here or send me a DM on Facebook. All right. Everybody have a great day and have a fantastic weekend. All right. Bye. Thanks everybody for Haley, Alex, Holton, Stephanie. I'm not sure if I missed anybody. And anybody out there who maybe didn't comment. Again, thanks for being here. All right. Bye-bye.